Welcome to Sales and Use Tax Training 101. Presenting today is Diana DeBello, Senior Solution Architect at Wolters Kluwer. Diana has more than 20 years of tax experience with primary focus on sales, use, and telecommunications tax. Let's join Diana for a comprehensive look at sales and use taxes.
Hello, and thanks for joining me today for Sales and Use Tax Training 101. I'm very excited to share with you some of the pertinent sales and use tax issues that affect your business. And today I'm going to talk to you about some topics that will affect you in your day-to-day work when you're dealing with sales and use tax. We're going to talk about Nexus, some business implications of the new Nexus landscape, business considerations, some common audit issues, some things to think about, such as exemption certificates and things that auditors will look at, and then some conclusions that you can take with you to look at the way you're doing business on a day-to-day basis. So when we look at the sales and use tax structure in the United States, you'll see that sales and use tax is not charged at the federal level. They can be charged at the state, the county, the city, and districts, and any combination, county and district, city and district. When it comes to these levels of taxes, it can be very confusing, especially at the district level, because they don't always follow geopolitical boundaries or zip code boundaries, mailing boundaries. So it can be difficult to identify exactly where you need to charge that tax. And that's one of the big challenges with sales and use taxes in the United States. This diagram displays the proportion of taxes for all states. So this information came from the Census Bureau and provides a breakout of the different tax types and the revenue that it provides the state. So you can see that the income taxes appear in the darker blue area. And if you look at the teal colored area, you can see the area covers the sales and gross receipts taxes. That's pretty impressive. A lot of the revenue that the states get comes from their sales and gross receipts taxes. It's the largest proportion of tax revenue for the states in the U.S. So it's easy to see why the state sales and use taxes are the important source of revenue for the states and why it's essential for them to collect that money from businesses out there. Why the sales tax? So as we just saw in that diagram, sales tax accounts for over 30% of the state's revenues nationally. Then consider there's states like Florida and Washington. They get over 60% of their revenue from sales tax. This is a majority of the revenue that they get to use to fund projects such as the state programs that they use for road maintenance, improvement, education, transit systems, all of those important things that the states do. The bottom line is that these state programs are supported by their sales and use taxes. Texas, South Dakota, Nevada, and Tennessee, they all get over 50% of their revenue from sales taxes. So imagine if you were to take away or decrease the percentage of that tax by a large amount, it would result in a huge impact to that state's revenue. That's why sales tax is so important to the states, and that's why they're so anxious to get that revenue from people like you, companies, businesses. So the state sales and use tax is imposed on tangible personal property. What is tangible personal property? Typically, it's something that can be seen, weighed, tasted, touched, something that's perceptible to the senses. I like to call it stuff. Telecommunications services, digital data, or electronic content can sometimes be considered TPP. The interpretation of what TPP is going to vary from state to state. And an example of this is the case of downloaded software. So it's important to understand how the states define tangible personal property, because some of the things like these electronic content items are up to interpretation. So really understanding what the states define them as is important. Then some states do tax services. For the most part, services will be treated as exempt, but most states do tax some specifically listed services. So there may be certain services that a state will tax. Professional services typically are not taxed by the state. However, there are some states like South Dakota that broadly tax most services. Hawaii and New Mexico are also like South Dakota. They have a broader base for taxable services. Again, like tangible personal property, it's important to understand what the state treats as exempt services and what they deem to be taxable services. So understanding the state's definition for services is important. So here, I'm going to give you a brief introduction to Nexus because the next few slides, I'm going to mention Nexus quite a bit. And then we're going to do a deep dive into Nexus because Nexus is one of the most important topics when we're talking about sales and use taxes. So Nexus is the minimum contact that is needed for a jurisdiction to have the right to require a seller to collect their tax. That's a mouthful, isn't it? This is that connection that a company has with the state that will allow the state to say, company, you need to collect that sales tax for me. Nexus for sales and use tax is not the same as Nexus for state income tax. There's a federal law, PL 86272, that defines the nexus for state income tax. But for sales and use tax, there's a lower barrier to prove for that state sales and use tax. So you can't use that same law as the state income tax. It's important to keep that in mind because even if you don't have nexus for state income tax, you may have it for sales and use tax. I've dealt with so many clients in my past experience that have said, oh, I don't need to collect that sales and use tax in those states because I'm not required to collect the state income tax. They may, in fact, have nexus in that state. Or they say, my accountant said that under PL 86272, I'm not required to collect the state tax. And that's not necessarily true. So again, it's very important to understand what your requirement is for Nexus. And we're going to dig deeper into this because even now, or especially now, as Nexus becomes more forefront in sales and use tax, you may be required to collect tax where you never were before. You hear us talking about the sales and use tax all the time. What is sales tax? What's use tax? Is it the same thing? Kind of. So I'm going to define for you the sales and use tax types. So sales tax is collected by the seller, and it's usually imposed on the purchaser. So when you go into a store and you buy something, you're charged a sales tax because a sale is transacted. Use tax, or a consumer's use tax, is complementary to the sales tax. It's the tax that is accrued when the sales tax has not been collected by the seller. So it's what's required to be paid on a taxable transaction when that sales tax was not collected. And then there's the seller's use tax or the retailer's use tax. And this is the tax that's required to be collected by an out-of-state seller when they have nexus with the taxing jurisdiction. So there you go. There's 3 types of taxes, more or less the same tax with different names. Now let's go through some examples just so that you understand the differences for use tax. For example, Company A, located in California, purchases taxable goods online from vendor B in Pennsylvania who has no nexus in California. Then vendor B does not charge Company A any California tax. Company A must accrue use tax based on the purchase of those taxable goods and pay that tax California. How about personal purchases that are made in states with no tax and brought home to a state that has tax? I live in Pennsylvania. Oftentimes, you'll see Delaware being advertised as the home of tax-free shopping. Is it? If you live in Delaware, it's the home of tax-free shopping. But if I go to Delaware and I make purchases of goods like a TV or a couch and stuff like that, and I bring it back home, I'm supposed to calculate the sales tax that should have been charged on that for Pennsylvania and then report it on my personal income tax, which of course I do all the time, don't you? And then of course there's the seller's use or the retailer's tax. So this is the tax that a seller is required to collect when they have nexus in a jurisdiction, but they're an out-of-state seller. So take, for example, if Bob bought shoes online and lives in California, the seller has nexus in California. Maybe they send trucks into the state to deliver there, creating nexus, but they don't actually have a store or anything in California. And the store is required to collect tax even though they don't have that physical location there. The seller needs to collect a seller's use or a retailer's tax. Confusing process, right? So on top of that, the states often call the taxes different things. So when you are starting to look at what tax you are collecting, you can come across different names for it, or the states even use different rates. So that's how use tax works. It can be confusing, especially when you don't know if your vendor has nexus or not. Just know that if you're not charged your home state tax, you may need to accrue it and send it to the jurisdiction. So let's look at the current nexus landscape. South Dakota versus Wayfair. Hopefully you've heard about this major U.S. Supreme Court case that was heard and decided in 2018. It overturned the physical presence nexus requirement. It was a landmark case that made huge changes in the sales and use tax world. Prior to 2018, the U.S. Supreme Court case for South Dakota versus Wayfair, the nexus standard was a physical presence standard. That meant that companies had to have some sort of physical presence in the state in order to be deemed a sufficient connection that would allow the state to require them to collect the tax. What did that mean? That meant that they had to have employees in the state, they had to have a location in the state, or they had to have some sort of other physical presence in that state in order to allow that state to say, you need to collect that tax. The states really felt that they were losing out on a lot of revenue, especially with all of the online sales that are being conducted. A lot of companies that previously didn't have to collect sales and use tax would now be required to collect it once Wayfair was affirmed. U.S. Supreme Court decided that economic presence was sufficient, and the states could say that an economic presence could require these companies to collect the tax. This made a lot of changes for a lot of companies that they didn't have to collect the tax prior to 2018. They didn't have that physical presence, but they were doing a lot of online business across the country. So a lot of companies have been doing nexus studies, and they've been discovering that they had nexus in these states. So what they've been doing is they've been doing voluntary disclosure agreements or VDAs where they go to the states and negotiate for prior liability. Some of these companies even realized that they had physical presence in states where they had people going in and doing installation or doing service in those states. So they actually did have physical presence. So it's been interesting to see the changes that this court case has brought about. So lots of companies have had to start collecting taxes, as I said. Even small companies have met thresholds that they didn't think that they would. And some of the thresholds are running between $100,000 per year of sales to $500,000 per year of sales. So even a small company can meet that threshold relatively easily. So it's really caused a lot of upheaval in the online and commerce industry. So the remote sellers are likely to have greater sales tax collection and remittance obligations. So the key driver for this and the reasons why the Supreme Court looked at this case were the amount of dollars that were being conducted in online sales. So the contention was that physical presence did not make sense in today's digital marketplace, and that some states passed laws to overturn the physical presence standards. For the past 10 years or so, a number of states have been putting forward different nexus schemes, alternate nexus schemes to try and trigger a U.S. Supreme Court case that would overturn the physical presence nexus standards. So that included the economic presence that South Dakota imposed, and a number of different alternative nexus schemes that we're going to touch on in the upcoming slides. But if you look right here, they feel that over $123 billion in online sales were conducted in just Q1 of 2018. That's a lot of money. Identifying what is going to be B2C sales versus B2B resale sales is going to affect that number somewhat, but still there is a lot of revenue that's being conducted online that the states felt that they weren't getting that tax revenue from. So how do the state tax administrators feel after the Wayfair decision? So they are very excited about it. They feel that they've gotten a windfall and that they're going to have so much more revenue as a result of the Wayfair case. This is what they have been waiting for a long time. I haven't seen any of the numbers yet. I am looking forward to seeing the numbers from 2018 and 2019 just to see how much more they are getting in revenue. I think it's going to be a lot less than what they expected, but it will be more than what they have been getting in the past. I've seen a lot of companies registering and starting to comply, but I don't think it's going to be as much of a windfall as what they thought it would be. So I hope they're not spending those revenue dollars yet. So it'll be interesting to get the reports coming in the next year or so. So here are those alternative nexus approaches that I mentioned previously. So there's economic nexus, which we talked about. That's established in an out-of-state seller when they make a fixed dollar amount threshold or a fixed number of transactions in a state. The click-through nexus is nexus created when an individual business provides a link to another website. Attributional nexus is created via relationship of an out-of-state retailer through an in-state affiliate performing an agency-like behavior. Then there's cookie nexus, not the kind you eat, but cookies that you leave on a computer. So when a vendor's website downloads its cookie or app, can create nexus. There's online marketplace providers nexus, so think about the eBays and the Amazon marketplaces. And then there's the customer information reporting and notice requirements nexus. So these are all those alternative nexus approaches we discussed, and I'll show you a couple examples of those. But let's look at this map first. This map is a great map that shows you all of the different alternative nexus approaches that the states have. You can look at Rhode Island. Rhode Island is really tiny, but they have every single alternative nexus method imposed in their state, as does Connecticut. So they are trying to make sure that they can get as many sellers as possible to have nexus in their state. It's very important for the states to capture the revenue from the seller's sales. So I thought that this is a great map to look at to give you an idea of what the states are thinking and how they're trying to capture those sellers into having nexus to capture that revenue in their state. So what is click-through nexus? I gave you an example here where there's a fishing lure company located in Maryland. They have no location, no physical nexus in New York. They make fishing lures and sell them on their online store. They have a relationship with a fishing excursion company in New York. The New York Fishing Excursion Company sells fishing excursions and publishes a blog on fishing. They host an ad for the fishing lure company on their website. If the fishing lure gets sales from customers clicking through from the ad, they pay a commission to the fishing excursion company. So the click-through nexus law states that the fishing excursion company relationship with the fishing lure company created New York nexus for that fishing lure company. because they received a commission from the fishing lure company for that click-through ad. And this is an example of a click-through Nexus ad. What is Cookie Nexus? Well, we're seeing it all the time now when you get those little pop-ups that tell you that the website stores cookies on your device. So this tells you that it could be creating Nexus for the company that's storing those cookies on your device. So most of the states have imposed economic Nexus standards as of June of 2019. There are a few states that have yet to do that, of the states that impose sales and use tax. These are the effective dates for the economic Nexus. You can see that some of the states do go back as far as 2017. So it's going to go back prior to the actual decision of Wayfair versus South Dakota. And it's important to understand what the dates are for the economic Nexus rules. And this is also helpful when you're evaluating your economic Nexus. So what are the business implications of this new Nexus landscape? Well, one of them is a lot of companies say it doesn't apply to me. I recently had dinner with a good friend of mine who's a consultant. She's a sales and use tax consultant. And she told me about this client of hers who kept insisting that Wayfair did not apply to his company. He refused to look at his Nexus and began to file in any other state than the ones that he already had a physical presence in. She tried to tell him, you need to look at it. That week, he had just received a love note from the state of New York in the form of $1 million jeopardy assessment. Well, my friend is going to get a big fat consulting deal from this client to go in and try and fight this jeopardy assessment. He's going to have to pay more than he would have if he had just listened to her in the first place. The best thing to remember is don't wait for the states to find you. That's risky thinking. The states are going to enforce this. It's no longer going to be that you can hide from the states. They're going to be sending out more Nexus questionnaires. They're going to just send out jeopardy assessments to see what sticks. And it's going to cost more to battle a jeopardy assessment than to be proactive and do your due diligence, do a Nexus analysis, and then register and be compliant where you need to be. So for me, the best advice that I can give you is to identify your exposure, follow the Nexus requirements, and then to impose and implement a solution that's going to ensure that you get the taxes calculated accurately. So what does it mean for your business? It could mean additional sales tax registrations, increased sales tax monthly filings, increased sales tax rate maintenance, taxability consideration, or audit exposure. Depending on what ERP you're using, if you're maintaining your own rates, then you're going to have to monitor those rate changes, what's taxable, what's non-taxable. States are looking at it. They may be sending you that Nexus questionnaire. It's just important to understand that these things are going to affect you, and it's going to be something that you're going to have to maintain. You're going to have to take a look at. What the states are doing and will continue to do, the states can now set their own Nexus standards. There is no small business exception. States are already passing legislation to collect sales tax based on economic Nexus standards. So a majority of the states have passed legislation for that. They're continuing to monitor newly issued Nexus standards to making sure that they stay compliant so their new Nexus rules don't get thrown out. The court did not place any limitations on the effective date of economic Nexus. So some states have Nexus dates that go back to 2017. So it's important to understand what the effective date is, as I mentioned earlier. And then there's some more business considerations. The complexity of sales and use tax. Sales and use tax is complex, but can be manageable. So what are the rates? So we talked about rates. There are a lot of rates. There's 24,000 plus variations of taxing authorities with associated taxes. So that's with all of our specialty databases. So I would say that there's over 10,000 specific taxing authorities within the United States. There's 6,000 tax rate changes that we perform every year in order to keep our rates correct and accurate. What is being sold? So what do you sell? Is it taxable or is it exempt? We do 100,000 different taxability changes annually. That's to cover all of our specialty data that we handle. There's enough data that's enumerated in the statutes that details all these special tax treatments for all these special scenarios. You have to be a tax lawyer to really understand a lot of this stuff. And that's why we interpret all of those tax statutes in order to create that taxability. Where is it being sold? The nexus. So understanding where the nexus applies, what the thresholds are, what the effective dates are, and then managing the sales tax for your exempt customers. One of the leading causes of inflated audits is bad exemption certificates or lack of exemption certificates. So this is a critical component of successful sales and use tax departments. So what should you consider now? Nexus, first and foremost, understand where you have tax obligations and physical and economic nexus. It's important to recognize the tax exposure that you have. Do you have past period sales tax liability? If you do, understand how to come clean with those sales tax liabilities, whether it be through a VDA, a voluntary disclosure agreement, through a business registration, the state registration requirements and sales tax, get a sales tax calculation software to help you with those sales tax liabilities. Then the tax requirements review of the current sales tax processes and needs. So know what your tax requirements are. That can be done and go through all of these steps again so that you know how best to do that workflow, because you need to manage that workflow. Use sales tax compliance management tools to assist you with that workflow to make sure that you're getting those tax returns filed on time, that you're getting the prepayments done, that you're getting what needs to be done timely and accurately, and then data accuracy. Are your customer addresses clean? Do they need to be cleaned up in order to get the accurate tax rate? Because as I mentioned at the beginning, finding that correct place to calculate that tax rate from is difficult because the tax boundaries don't necessarily align with addresses. We need to make sure that those addresses are clean and we can pinpoint the exact location of those tax rates. Things to evaluate. So when you're looking at tax treatment, tax work process, you need to look at the product considerations. So the taxability of items varies by state, tiered and reduced rate taxation for certain items. So if you're using an ERP and you're using the native functionality in an ERP, then that's not going to be covered in the ERP native tax calculation. You need a tax engine that's going to help you with the support of the taxability of the items that varies by state, and if you have tiered and reduced rate tax for certain items like manufacturing, or if you're in Tennessee and you have that Tennessee tiered tax. The customer considerations are even greater. If you have customers in multiple states, the ERP is unable to support varying taxability for a customer accepted in one state, taxable in another, or for multiple ship SKUs. So we talked about the exemption certificate issue being one of the top reasons for inflated audits. So you're going to be audited. What now? You are going to be audited. I mean, it's inevitable eventually. Prepare by doing your own audit. That's one of the best ways to know where your exposure areas lie, to do an internal audit of your sales and use tax exposure. When you are going to be audited, know what your rights are and remedies for the state that's auditing you. Understand that each state is going to be slightly different in the way you approach what your rights and remedies are. And the best thing to do is to understand that ahead of time and what your option is. When you do your own audit, identify that exposure ahead of time as well. And don't be passive during the audit. An auditor is going to identify any potential thing that could be a liability, could be exposure. But you need to really do your due diligence and make sure that anything that you have paid correctly, that they're not putting into that error. I worked on a client that the report they were looking at didn't have the quantity in it. And they were selling clothing in New York. And every line item that was over $110, they were calculating the tax for under audit. So they came to me and they're like, I can't believe how high this New York audit is. And we were looking at the report, and the tax guy is saying, I know my stuff is not over $110. In New York, there's an exemption for clothing $110 or less. So we're looking at the line items. We realized the quantity was not on the report the auditor was looking at. So we had to create a report that actually showed the quantity of each of those line items so the auditor could see that it was 3 shirts at $70 instead of $210. So those are the types of things that you can do ahead of time and identify any of the gaps so that you can be prepared and you don't have to go through any of the follow-up processes post-audit. Prepare to identify where you can fight back or where you can negotiate what is being proposed on the auditor's work papers. And it's always helpful to identify who's going to be your legal assistance. Some states require that you have an attorney to assist you through some of the steps in the remedy process. In a 2016 Aberdeen Group study on the financial impact of audits, 97% of respondents say their organization has faced at least one audit in the last 5 years. The fines are up to 2% of their organization's revenue. That's fines. That's above and beyond what the tax was. So it goes back to my old adage, is that if you're doing sales tax correctly, it's a pass-through tax that you're charging to your customer. If you don't do it correctly, then it hits the bottom line because you're paying it, and then you're paying the penalties and the fines and interest on top of it. So it's important to really try and get it right and charge it to your customer to minimize the impact to the bottom line. Some common auditing issues are going to be those missing exemption certificates that are incorrectly completed, use tax. So if company is not accruing the use tax on certain items such as fixed assets and expenses, sales tax when companies are exempting taxable items or services, and then not taxing transactions in a jurisdiction when you have nexus, and then knowing where you have nexus and drop shipment scenarios. So sometimes in drop shipment scenarios, you may be required to collect tax at the destination rate. You may not be eligible to use a resale certificate. It's important to understand how the drop shipment scenario works and what the states accept as valid documentation for those drop shipment scenarios. Audit enforcement and exemption certificates. The states don't always accept exemption certificates that are incomplete. If they're missing, they don't always allow you to go back to the customer to try and retrieve it. So the states will require you to pay the tax on that transaction that you exempted. It may be a wholesale transaction. It was a sale for resale. They don't care if you don't have a resale certificate to justify it. So it's important to know that you have the correct documentation. I can't emphasize enough how important exemption certificates are and making sure that you are collecting tax in the right jurisdictions. Final conclusions: understand the tax landscape, know your areas of exposure and opportunity, prepare for the inevitable, because you are going to get that Nexus questionnaire and you are going to get an audit notice. Identify your needs for automation and tools, because there are great tools out there that can assist you with all of these things here and learn from others' experiences. Then plan and execute. It's been a pleasure presenting Sales and Use Tax 101 to you today. I hope you'll use this information to help you take control of sales and use tax compliance processes and reduce your audit risk and effectively manage complex issues. Have a great day.
Thank you for joining Wolters Kluwer for this presentation. Please contact us for more information on how our intuitive sales and use tax solutions can help protect your business and increase your productivity.